This is mind-boggling stuff. It's going to surprise a lot of people. I don't think many people have even thought about this. This is a multi-trillion-dollar trade. This is what we're seeing happening right now is all in preparation for when Russia takes over the chairmanship of the BRICs in January 2024. It's only a couple of months away. And the Sino-Russian alliance is accruing physical gold in preparation for this, to power Glazev's 20 commodity gold-backed currency. Now, Russia has turned up competing. What they've done is turned up competing to get spot gold and futures liquidity.
Andrew Maguire, an independent London metals trader and analyst, is widely recognized for his unique ability to read the precious metals market. In this video, Maguire predicts that Russia gold-focused initiatives will have significant global financial implications. There has been quite a bit of coverage of the emergence of a new economic bloc called the BRICs. Among the 2024 members, some have large populations and some have multi-trillion-dollar economies. The sides agreed on close interaction in the context of Russia's BRICS chairmanship starting on January 1, 2024. An exchange of views was also held with regard to the upcoming G20 summit in New Delhi. Russia has been gradually increasing its reserves for a long time, doubling them to $640 billion in the last 5 years alone. Especially since the annexation of Crimea in 2014, Russia has consistently reduced its dollar-denominated reserves and has tripled its gold reserves. Additionally, Maguire highlights that gold emerges as the genuine contender to the US dollar as a multi-trillion-dollar foreign exchange currency. The U.S. national debt, inflation, and the potential for an emerging currency that uses gold to derive value could cause the bull market to climb to higher highs over the coming years. A BRICS currency should be a bullish development for gold and gold-related assets. Now we are presenting you the glimpse of Andrew Maguire insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, we request you to subscribe to our channel and activate the bell icon for timely updates.
And while Russia currently provides a large energy discount to attract a bullion, even allowing physically backed futures to lock in very large trade at settlement discounts as far out as April. Now, once the currency has sufficient liquidity, it will set the global price. The inflationary aspects for the Fed and the Western dollar-denominated commodity prices will be massive. We talked about this before. And at the margin, the increasing demand for gold to back up this multi-trillion-dollar trade will increasingly raise the offer price of gold in the global markets and place the wrong-footed Fed further on the back seat. Along with the UAE, Saudi is seeking to ultimately control the bulk of the price-setting mechanisms of pretty much 80% of global oil production. And with Russia being the most sanctioned of all the BRICS countries, it incentivizes Russia to lead the way in looking down the gold, in really just lock down the gold element. You need to power this currency with that, of the current multi-trillion-dollar trade. And that is a multi-trillion-dollar trade. So is the dollar is, gold is, and oil is. I mean, all these things come together. It cannot be ignored. And gold will become the beneficiary of this multi-trillion-dollar trade. What escapes most pundits is that the only competing multi-trillion-dollar foreign exchange currency versus the dollar is multi-trillion-dollar foreign exchange gold. This market is beyond most people's comprehension because they're locked inside the casino. And the Sino-Russian alliance is what it's doing is capitalizing on the fact that foreign exchange gold is now both physically backed as well as a first-tier asset class. Again, something that's ignored. And the footprints are there to see. Despite the ruble significantly weakening against the US dollar, almost to the point when initially sanctions were placed against it, we have for some weeks now been evidencing a consistent spot gold premium being offered by Russia for bullion, significantly over and above that set at the PM fixes, which we've just seen one of. This is also evident in the gold-backed Moscow futures contract. However, these Russian gold premiums really expanded last week, and they're holding strong again this week, very strong. This is no coincidence. So what's going on? It's actually simple. Russia is actively bartering energy for gold and offering a much higher gold price to attract these bullion inflows. This is just the thin end of the wedge, serving two main purposes, really: attracting global bullion inflows with a view to ultimately backing some of the 20 most liquid commodities, all of which are traded between BRICs members, of course, while also serving Russia to swerve sanctions. Now, through our Russian contacts, we've been verifying this is all the hallmarks of a fresh mandate to attract gold bullion flowing into Russia, and notably under the cover of the CME LBMA gamed fixes, which only serves to rinse these spec cartels' useful fools out of their paper positions. These unleveraged physical bullion outflows are sucking leveraged physical liquidity out of the LBMA ring fence into the directly competing Moscow spot gold and Moscow COMEX competing physically backed, I will stress, gold futures platforms. And the footprints are so clear. Despite a severely weakened ruble, as we've said, against the dollar, that is, we've evidenced extremely large premiums being paid to attract bullion into both Moscow futures and these spot live contracts.
Globally, central banks reported net purchases of 55 tons in July, according to the latest data compiled by the World Gold Council. Maguire also mentions, back in 2008, paper and physical gold experienced a 3-year rally, with silver also surging alongside. The 2008 to 2011 rally that saw spot gold almost triple in value to reach a record of $1,920.30 an ounce was built on 3 pillars, namely strong physical demand from top buyers China and India, robust central bank purchases, and appetite for a safe haven investment amid the fallout from the global recession. Meanwhile, Maguire highlights growing acceptance of gold as a Basel III compliant top-tier asset on COMEX. The proposed rule aims to update capital requirements for large banks with assets over $100 billion and finalize the Basel III agreement's remaining components, often referred to as the Basel III Endgame. Let's get back to the interview.
On Friday, just before the Fed intervened in the crosses, the Fed was just 30 cents away from losing control of gold the next time this level is breached. So keep an eye on it, and it will, watch out above, as the Fed will be hanging onto the coattails of what is a very large central bank, physically driven end of year gold revaluation rally. Now, we're going to explain why in a second, but in the meantime, what an opportunity to stack some physical bullion at these COMEX diluted prices. I mean, look at what we're seeing today. Absolute paper, complete paper generated, nothing to do with the physical market, and incredibly divergent from what we're seeing. It's important to understand the change in gold's behavior versus dollars and bonds. And we've been drawing public attention to multiple bouts of gold rising alongside a rising dollar. And this 50-year paper-centric inverse algo is actually showing signs of dislocating as both paper and physical gold are increasingly sought as a first-tier safe haven asset class. And the last time we evidenced anything close to the scale of such a dollar index gold disconnect was back in 2008, when gold rose alongside the dollar, and both began to compete with each other as safe havens. Now, following massive bank failures this was, and obviously downgrades, that was in 2008, both paper and physical gold were chased into a 3-year $1,200 safe haven rally with inconsequential small pullbacks along the way. And joined at the hip, silver also rallied alongside the dollar index, and that rose $40 as investors exiting bank investments also converted bank withdrawals into safe haven silver. And really, that was when the gold and silver was looked at as, my goodness, I want to get out of risk. Where am I going to put my money? In the bank? No, the banks were going down. So what would you do? You have choices. It would be a commodity. It would be a precious metal. It would be gold and silver. Now, the Fed is now playing with fire. If they insist on walking this rate hike talk, we likely see the bond yield spike higher again, which would almost certainly trigger the pre-warned Jackson Hole, Fitch and Moody's first tier, too big to fail bank downgrades. And if you remember, we talked about them. They're in the sidelines waiting for Jackson Hole. And we've seen hawkish comments. Now, that would open the potential for a concurrent dollar and gold safe haven rally to unfold. Only this time, gold, this time is now a first-tier asset class, unlike when in 2008. However, more immediately, under the deliberately induced volatility that we're witnessing now, we're looking at a more contained, but nevertheless very bullish setup that is structurally very similar to the most recent Fed-induced gold interventions, which actually capitulated earlier than they would have liked back in March of this year. And that is quite recent. And to be clear, we're discussing a wholesale market setup that closely mirrors the structure that followed what was the most recent last major round of Fed gold market interventions. And they similarly, they capitulated, as I say, in March, and that was at $1,818. We talked about this before. Silver was bottoming out at $20. Now, as far as paper gold markets are concerned, there's evidence that an increasing number of COMEX, commodity trading advisors, have recognized that Basel III compliant gold morphed into this first-tier asset class on the 1st of January and are increasingly employing gold as a risk hedge.
As central banks globally continue to bolster their gold reserves and the possibility of a gold-backed currency looms, the future of the gold market seems highly promising. Similarly, the International Monetary Fund's World Economic Outlook estimates that in 2028, the BRICS countries' GDP, in terms of purchasing power parity, or PPP, will account for 33.6% of global GDP, with the G7 countries' GDP declining to 27.8%. The new composition, including Saudi Arabia, the UAE, and Iran, would almost double the BRICS market share, giving them control of nearly 80% of global commodities output. What's your take on gold's potential as a multi-trillion-dollar foreign exchange currency and how it might influence the global financial system? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.